I just want to get quickly a reaction from you on what is the world's biggest IPO. Would you buy Saudi Aramco stock?
Yeah, at the IPO price, I would. I think it represents at the IPO price a good long-term value. I mean, in general, we at SkyBridge right now are very cautious on the overall global market because of valuation and what we predict will be a earnings recession going into 2020. It's not that the economy is bad fundamentally in the U.S., but there's just not a lot of juice left in the earnings. So that could roll the market in general, which could have a deleterious effect on global stocks. But that security, that company at the IPO price, I do think represents good long-term value. So if you're going to hold that security for 5 to 10 years, you'll do very well with that security.
Anthony, it's Tracy Alloway over in Hong Kong. It's good to see you. I'm going to get over to one of the world's other top stories, which is, of course, the Democrats laying out the map to impeachment for Donald Trump on power abuse and also obstruction. Is this the right move for the Dems?
Well, I don't necessarily know if it's the right move or it's the wrong move, but it's definitely the constitutional move. If you go through the 128-page, effectively, what is the indictment that the Democrats wrote up in the House, it's a pretty compelling case in terms of what took place. And so then you have to ask yourself, if you've sworn an oath to the Constitution, are you going to hold people accountable to the system and the rule of law in the United States? And so I don't really think they had much of a choice, frankly. As it relates to politics, you know, we'll have to see what happens. The Republicans have more or less held the line on behalf of the president. And I think if you get some of those guys on your network, you should probably ask them, OK, what are you guys doing exactly? Because if you want to disavow the Constitution for one man, you're setting up America in a way that I think will have a very bad outcome, not only for our political system, but for our markets and the way people think about America around the world. So you have to ask those people why they're doing that. But I completely understand where the Democrats are coming from.
What's your top concern at the moment? Is it the global slowdown in terms of GDP, or is it what's happening with U.S. politics, or is it trade?
Well, if I had to rank everything, I would definitely say the global slowdown and the notion that a good $17 trillion of government sovereign debt is in negative territory. I think that's pretty, that's signaling to you that if the world is slowing down in growth, it will pull America down as well. Unfortunately, we're coupled way more tightly than most people think. Secondarily, I would say trade. U.S. politics, I say, believe it or not, is like a more distant on the list because, the Federal Reserve is basically driving markets and driving the economy. But those asset prices, as a result of Federal Reserve policy, are affecting about 3% of the world's population that own the assets. I think the strain in the political situation, not only in the United States, but around the Western democracies and most of the world, frankly, is that those 3% of the people, their assets are going up. But the other 90% of the people, their wages are either roughly stagnant or sticky downward, which is an economic term, meaning that, they're losing their purchasing power gradually over time. And I think that's what's causing all this anxiety and angst. So it's more the wage gap as a result of what's going on with monetary policy that I'm more concerned about. U.S. politics will sort itself out. The president's obviously engaged in lawless activity. They'll have to just decide if they want to accept and allow him to engage in that. But if they do, look out, because he'll commit another crime at some point, either in this term or if he gets reelected in a subsequent term.
Anthony, since you brought up U.S. monetary policy, I'm curious what you think about Trump's attacks on the Fed and his repeated, let's say, pressure to get them to actually bring down interest rates. And the reason I bring that up is because last year you said that you thought Trump would actually lean on the Fed to raise rates in order to benefit constituents who are trying to earn more interest on their deposits. So are you surprised he's actually going for lower rates?
Yeah. Well, I'm not surprised because I think he's determined that the stock market is the only pole effectively, metaphorically, that he's looking at. But I can take you guys back to July of 2017. I was in the White House for a short period of time, but it was a Wednesday. And the reason I know it was a Wednesday, I was only there for one Wednesday, and we were having the conversation about interest rates. And the president's base is really a base of savers. They're blue-collar people that have money in CD deposits and community banks. And one of the litany of complaints on the campaign trail in 2016 was what happened to my CD. I was getting 5-6% on it. Now I'm getting 80 or 90 basis points. They don't talk in basis points in those areas, but you get what I'm saying. And so the president's response 6 months into the presidency was he wanted higher rates. He actually gave an interview, it was an interesting interview, about 8 weeks ago, where he talked about the need for higher rates for savers, but you can't do both. And so you've got him jawboning the Fed to go for lower rates. I don't think that's having an impact on Jerome Powell, by the way. I think he is a very independent Federal Reserve chairperson, but I think he's looking at data that has him concerned, data in the repo market, data as it relates to liquidity around the world, and I think that's why they've turned up the gas on purchases.
Let's talk about some of the asset allocation ideas that are on the table for you. In which strategies is SkyBridge's marginal dollar going?
Yeah, so we're in our most defensive position that we've been in. SkyBridge is going to celebrate its 15th anniversary in March of this coming year. And we're in the most cautious position that we've been. Our beta is about a 0.1. We have very little interest rate duration right now. And so for us, we're in structured credit. We own a lot of the sort of preferred bonds in the community banking sector because we think that represents a lot of value. Our loss-adjusted yield on the portfolio is about 9.5%. So we're hoping for a 6 to 8% return next year with very, very low volatility. But we're worried, and I think we're set up, if the market's correct, we'll have a spectacular time in the distress cycle, which we're known to do pretty well in. But I have to confess to you that I'm very worried about next year. Not that the economy's going to roll, but in an earnings recession, and the Fed really doesn't have a lot of room to move, what we've noticed is there's a real lack of liquidity in the global stock market. The Volcker rule is having a bigger impact than people originally anticipated. There's probably $450 billion of proprietary trading capital that's been removed from the markets over the last 10 years, and you can see that in sort of stock market volatility and gyration over the last 12 months.